Kalpesh, if I'm audible to you, we've got a breakup of all the banks, a list of 13 banks, and the cumulative amount is 22,915 crores. What is your first reaction? I mean, this was mostly factored in, but something like a Bank of India, some of these tier 2 banks, Bank of India to get around 30, Indian Overseas Bank to get 3,100 crores, and something like Punjab National Bank to get 2,800 crores.
Yeah, I wouldn't know. I mean, how much each individual bank can get, but more importantly, what will happen is as we are approaching towards Indian IFRS, which is called Ind AS, and there is going to be an first impact assessment of all those banks to be released by 30th September, by 30th November for 30th September number, and that will drive the real expected loss built into their capital. And accordingly, the requirement of capital may get crystallized more closer to that date and will drive some more decision from the government after that as well.
Mr. Mehta, also, our understanding is that total amount of money that the government had committed was 70,000 crore, and this is over a 4-year period. Currently, right now, the announcement which has come is only for 22,000 crore. Do you think this number in itself sounds reasonably big enough for you to help them be recapitalized, or is this number slightly lesser?
This number, whether it is adequate, I mean, some of those, as I told you in my previous comment, is that it will be more closer to the date of their Ind AS on expected credit loss built into that. I mean, would quantify the number, but right now I feel that when government assumes that it will be applicable for next 3 or 4 years, which is the time when they are going to actually change over to accounting rules, change over for Basel III or Basel II advanced approach completely, and all of that will require that capital in that period. And that is probably the reason government estimated that it will take about 3 to 4 years for them to infuse the whole capital.
Right. Kalpesh, in terms of the additional tier 1 capital and the CET, the quantum has not been quite enviable, as has been raised by the banks, and the bigger guys who can absorb this, the insurance and the pension funds, have not absorbed too much of it, at least till now. Your outlook and your view on the same?
No specific comments. I mean, all the segments will have a different capital requirement, and time will tell us in terms of based on numbers how it transpires, and we can observe that. And all of them is, according to me, significantly linked to the accounting changes which are happening and which is requiring them to recognize certain asset liability valuation changes far ahead of realization. So it's basically mark to market of those assets and liabilities, which will drive their capital assessment, capital sufficiency assessment, and then accordingly the capitalization requirement.
Mr. Mehta, we have seen last 3 or 4 quarters of very heavy provisioning numbers, not the best NPA numbers. This is a part of fund infusion the government is doing into banks, but the other part is also banks creating, rather raising funds via selling stake or raising funds from the markets in terms of sale of equity. Do you think the market is conducive enough right now, or does the market have enough appetite to go ahead and absorb a big stake from one of the PSU banks which has not the best set of NPAs? Do you think the market would fund something like that?
Market would. I mean, as the RBI rules are actually have over a period of time taken care of some of the refinancing and the parity between kind of the hedging which was there between bank and an NBFC. Now the time has come where there can be a real opportunity for funding some of the assets. And once you've cleaned up all your actual event-based losses which are coming out of the asset quality, then it is now onwards probably then it becomes more kind of a fungible asset in terms of ability to fund it from local market or an international market. And accordingly, when the fund starts moving in to the banking system will be more prone to raise capital even in a domestic market through aggregation or through a kind of a offer for sale or something like that.
Right. Given the kind of, as Shell was also mentioning, Kalpesh, the kind of aggressive NPA provisioning that has been done, do you think that 70,000 crores over even a 3-4 period is a smaller amount relative to the requirement? And if you have any estimates as to whether or not it needs to be revised on the upside a little greater than 1 lakh crore?
I don't have a real sense of numbers in that sense because those are all kind of, it comes out of the audited number or any of the management analysis which this banks keep on disclosing. And I go back to my first comment as well, because these are all kind of incurred losses and actual event-based losses being recognized on NPAs or asset quality issues. Now, when you move on to those accounting changes, you are starting to make an estimate of out of the existing loan book which you have, whether or not the loss event has occurred, what is an expected loss out of that. And that assessment will really drive the total level of the non-performing asset and related losses one has to provide. Not necessarily titled as NPA, but out of the good loan book also, what is an expected loss. So there are right now the provisions relating to the standard assets, unhedged foreign currency or other losses which banks has to provide as per the IRAC norms of RBI. But in addition to that, there will be additional losses which will come out of the expected credit loss model, which to certain extent do the banks, some of the banks who have already followed Basel II advance, may have factored in for capital requirement, but not for financial recognition. So that is what will drive over a period in terms of the total assessment, whether the quantum is what is declared is sufficient or it needs extra.
Right. We also have been joined by Hemendra Hazari, independent banking analyst on the phone line. Good afternoon, Mr. Hazari. It's good to have you on an important day like this. 22,915 crores, the overall commitment, and we have a bank-wise breakup as well. SBI to get 75 crores, Indian Overseas Bank to get around 3,100 crores. But really, I want your first reactions on this to start with.
I think it's a positive first step, though it will be inadequate, but nevertheless, I think it's a very positive and heartening step that the government is immediately recapitalizing its banks and is recapitalizing them through pure equity and not through some quasi-debt type of instrument, because this will result in higher tier 1 capital ratios for the government banking sector. It would give them now, more equity for which it can provide for bad loans, and it will give confidence to the capital markets that the government is injecting capital at a time when there is serious issues of asset quality in the economy.
So do you think that the whole asset quality picture and also the bank asset quality cleanup which has been undertaken over the last 2 quarters, things will get better as we go into the next 2 quarters?
Unfortunately, I do not have such an optimistic scenario, because I think we're going to be continued to be plagued by poor quality assets for some time, because not only now you will have the small and medium enterprises sector which is undergoing tremendous stress, they will also be showing up as NPAs. But you'll also have a lot of agricultural loans, in my view, which will show up as NPAs. So the stress is going to continue for some time. And therefore, I don't think the pain is going to be over. But as I said, at least the banks are getting additional capital. So therefore, they can have some cushion to provide for their losses.
Mr. Hazari, I want to ask you on the additional tier 1 capital and the CET. I mean, the bigger absorbers of the additional tier 1 bonds, which is the insurance and the pension money, they haven't absorbed as much as they would have ideally, and a very small quantum of that. What is your view as far as AT1 and CET is concerned?
Sorry, could you come again? I didn't follow this.
So as far as the additional tier 1 bonds are concerned and the CET requirement as well for some of these public sector banks?
They will improve now, because if my understanding is correct, they're going to come in as straight equity to these banks. So you would see an improvement in the tier 1 capital ratios of banks. And I would just like to point that although the Reserve Bank of India has loosened the tier 1 capital norms by excluding deferred tax assets, these are things which any analyst would actually will knock off from capital. So therefore, I'm saying that this additional is going to be positive, at least for the government banking industry.
Right. So also in terms of bank-specific cases now, I mean, Allahabad Bank gets around 44 crores and Bank of Baroda gets nothing. I mean, what is your reaction specifically maybe to two of these banks?
You see, it appears the initial opinion is that the government has done this dispersal of equity by 2 considerations. One, it has gone by the market share of these banks, which like SBI gets the largest share naturally, and 2, by those banks which are perceived to be weaker will get additional capital. So that seems to me, the issue that you are raising.
Mr. Hazari, also, you are of the view that 70,000 crores spread over 3-4 years is not adequate. By how much do you think that, and I know this can be mere conjecture at this point, but in your view, by how much does the quantum need to be revised upwards to be in a better position for these banks?
See, for this financial year, the government should have included 100,000 crores. And then we could have seen how the asset quality situation, comes out. But this figure of 70,000 crores spread over 3 years is totally inadequate for the kind of asset quality problem that the Indian economy is having today.
Right. We also have been in conversation with Kalpesh from Deloitte Haskins and Sons. Kalpesh, as far as the asset quality is concerned, and specifically the sectors to which it's most skewed towards, infra, steel, do you see some revival going ahead? Because whatever it's going on right now, the operational profitability improvement in these sectors is on the back of artificial stimuli that has been infused by the government. But do you think it is sustainable at all?
The industry performance obviously would be depending on a lot of policy matters by government, and some of them are really helping in terms of the infra segment, in terms of ability to do kind of some of the refinancing of the assets, ability to deleverage, whether using an InvIT or any other model, and that is going to actually help revival of those sector and where their ability to repay their dues to the banking segment. And the banking would probably create their exposure by investing in a different mode, which has a better kind of ability to recover those dues versus what they have it in the current form, which is straight credit.
Kalpesh, I need to cut you short, pardon me for that, but we have Arun Tiwari, CMD Union Bank, on the phone line with us. Good afternoon, sir. It's good to have you on such an important day. 721 crores by way of the first tranche. First reactions?
It's good, and it also shows, because I was also told the numbers of some the amount infused in some other banks. So it proves that we don't have that crying need as a bank.
So, when you're looking at the next 6 months, 9 months period, can you tell us what is the amount of money that you will require?
No, if you look at, money will be required the kind of trade growth you are expecting. Number one, and we have been consistent for last 6 quarters, whatever growth projections we give. And in the sectors we are growing, I think the end result as of 31st March said it. Earning profit 13,352 crores. So the way we have been moving the balance sheet or the sub-segments of the balance sheet, I think we should be able to generate internal capital substantially.
Right.
And whatever is our target for the credit growth, what we have kept at about 9%, we shall be able to do that, A, with lower risk weight, which will be capital light, and which will be giving me more profits.
Right. So in terms of the requirement from internal accruals, how much do you think will that be, and will be able to compensate for the infusion by the government?
As of today, every 100 crore infusion increases my capital by 3.5 basis points.
Okay.
And as of today, if I look at my tier 1 capital, it's the tier 1 is 8.14.
Okay. In terms of the additional tier 1 bonds, what are the plans in terms of raising via that?
We have been very consistent on one thing, that we have had this shareholders approval for last 2 years. As of today, I'm holding shareholders approval to raise 3,200 crores through various modes, which includes QIP also. But when I don't need, because now the fact remains, I am a commercial bank. If you have CRAR, which is much above the prescriptive limit, still you are incurring losses. I don't know what sense it will make if the capital is raised at this point in time when the price to book value is at its nadir.
Okay. So, if you're saying that you have a board approval to raise up to 3,500 crore, are you waiting for the right time so that the valuations are better?
That is what, my dear friend, that is what we have been very consistent, at the right time, at the right price also.
Right. Mr. Tiwari, also tell us in terms of recoveries and upgrades, is the picture improving? Because we have had certain banks...
Yeah, you're right. This I had told after our annual numbers when we came out with the press and the media. We did say going forward, yes, there would be deceleration, and we are holding on to that statement.
Right. Sir, in terms of provisions, and I understand that this is a silent period, but you will be constrained. But I want to ask you specifically in terms of the S4A, how does that make matters better for a bank like yours? Because given the kind of stress sectors that Union Bank and other banks in your category have exposure to, infra as well as steel, the non-sustainable portion and the aggressive discounting that you have to do on your books becomes a little untenable?
No, if we do it honestly, sitting across the table, all stakeholders coming on the table honestly, I think it should work. I mean, we are yet to see. Only one case which we know is of this Mr. HCC. Going forward, I'm sure there would be more cases like that. And ultimately, the businessman is in the business, and we are also in the business of banking. We will go to the extent we can go in a reasonable manner. Nothing beyond that.
Fair point. Sir, in terms of the corporate book, I mean, many public sector banks are undertaking consciously pruning of the corporate book exposure. Can you throw some light on that?
No, if you have tracked the Union Bank of India for last 2.5 years, our growth is coming from consistently last 10 quarters I can vouch for, from retail, agri and MSME. And as a result to that, this segment now is about 52-53% of my loan book, which was about 44% 2 years back.
Right. So in terms of the agri exposure, do you think that the recoveries there and the NPAs there are likely to ebb going ahead?
Sorry, come again. What do you say?
So the agri exposure.
Agri? No, not really.
So,
not really.
No. What I'm asking is that are the NPAs expected to go down given that we have had a good spatial and temporal distribution of the rainfall?
That's what I'm saying. That's what I'm saying. Or I said before that there would definitely for our bank deceleration quarter after quarter during the financial year in the fresh accretion of NPA.
All right. Thank you so much, Mr. Tiwari, for sparing time today.
Thank you.
That was Arun Tiwari, CMD Union Bank, telling us that, of course, the quantum of 721 crores is healthy for this time around. And even if you factor in recoveries and upgradations, the requirement might not be that much for a bank like Union Bank. We also have with us, and we have been speaking to Kalpesh Mehta of Deloitte Haskins and Sells. Kalpesh, coming to you in terms of the recoveries, I mean, do you think that for certain of these banks, obviously you cannot take a broad brush and paint all these banks, but for certain of these banks, in terms of recoveries and upgrades, for instance, PNB is doing well on that end, the requirement might not be that aggressive?
The requirement of?
Of infusion, capital infusion?
Requirement of the capital infusion on a particular bank, whether it is aggressive, relative, I mean, it all depends on their overall asset quality and the losses which they've already recorded, and which some of them, based on their assessment, they expect to incur more losses in future, and that will drive the adequacy of the capital requirement, and rather than whether it is aggressive for one particular or other. I'm sure they would have done some relative assessment of the asset quality before taking such decision.
Kalpesh, before we let you go, if you have a view on this as well, in terms of the expectation of a rise in terms of the provision that has to be made, a final view on it, do you think that amount needs to be tweaked on the higher side?
Right now, it's, as I told you earlier, it's event based versus expected loss, and once it moves into the expected credit loss model, it is likely to go up over a period of time, and early recognize some of those which otherwise comes on an event based rather than expected based.
All right. Thank you so much, Kalpesh Mehta. That was Mr. Mehta from Deloitte Haskins and Sells, who joined us with his view as far as the bank recapitalization is concerned. And this is the first tranche. A quick recap. We have the total quantum at 22,915 crores to recapitalize 13 public sector banks. That's the news coming in. And in terms of the quantum, if we have a breakup, SBI gets the lion's share, 75 crores. And mind you, this is the first tranche of the overall 70,000 crores that has been committed and was highlighted, 25,000 crores of it in the budget as well. Indian Overseas Bank with 3,100 crores, Punjab National Bank with 2,800 crores, and something like a Bank of India with 1,784 crores. The graphics are up for you. Canara Bank gets 997 crores. We had the management of Union Bank also on the phone line with us, who seemed to be satisfied with the number as far as capital capital infusion is concerned, and was also of the view that recoveries and upgradations also play a part in this. So at this point, it is okay, and they also have options to raise further capital via QIP, but they are not exercising it at this point. So that's about it. Let's pull up the public sector bank index also, and we saw that Canara Bank was the top gainer on that index. And if you take a look at certain of those stocks now, specifically something like Canara Bank is up 4%, even a Punjab National Bank, mind you, two banks, Allahabad Bank gets only 44% and Bank of Baroda gets nothing. So watch out for those banks as well. But overall, you're seeing a sentimental bump up as far as most of these banks are concerned. All counters on the PSU bank index are up in trade and mostly near the high point. So this accentuates the kind of run that you have seen on these ever since the start of the month of July. Well, with that, it's a wrap on this edition of Market Pulse. Lunch Money is up next.